Good morning, good morning, good morning. It's Thursday morning again. It's Thursday, right, Patrick? Yes.
It is Thursday. Yep, every Thursday.
I lose track of days when I'm traveling. It's awful.
The weeks fly. The weeks fly by.
Oh gosh, it's already August, the middle of August. And so, yeah, super excited. We are, last week, just wanted to address, because I know I kind of abruptly left, and for those that are joining the investment series, I just wanted to recap. I had a couple of messages at the end there, and basically I had a son that went into surgery, and that was really difficult. He had a chest depression in his chest. He had his chest wall opened. The recovery has been very difficult. And so, just working through that with my son, and he had to have an emergency surgery. He had several complications. It's been quite the disaster. He had the bracket that was placed in the bar and his ribs busted. So now he is still recovering. He has chest x-rays today, and we're just praying for him to get through his healing. 1 second here. So that's that. But thanks to everybody for your prayers. And Patrick, thanks for carrying the show. I'm sure you did an awesome job. And sorry, I had to jump off. But
you're in transition. You're in a lot of transitions right now. You're in an Airbnb, medical transitions, maybe a move. Yeah. You got a lot going on.
Yeah, it's really crazy. And I'm grateful that I've always been someone to operate by my faith. And so I am so grateful that the peace of God has definitely led every aspect of of everything that we've been, going through. And then for those that don't know me, yes, I took the title as Miss Alaska this last weekend too. That was something that had been on deck, and I almost did not participate. And my boys really encouraged me to go, and so that's an interesting thing. And for those, I get a lot of questions like, so what do you do? Well, the great thing is that I'm already involved in a lot of, especially even in my military service, in my real estate business. I do a lot of community outreach already. That is something that is just an organic part of my life. And so now I'll be able to do that as having a title as Miss Alaska. So that is pretty cool to kind of bring more light to the causes that are already, a passion of mine. So I'm really excited about this year and kind of the plans, but right now it's focused on national. So that's
what's the next steps? Yeah. What's the next steps? It's kind of interesting. I know we got to get into real estate, but just another 10 seconds. What's the next step with that?
So it's the Miss America pageant. We'll just prepare for nationals. The most preparation is just on all the superficial stuff, but interview is actually 50% of your score. So, your substance is really what kind of leads that organization. So it's really cool when you actually stand for something. And so that's been great. Yeah. So awesome. Our national platform is actually addiction and overdosing and stuff. The founder's daughter died of an overdose. So we're it's called Victoria's Voice. We're raising money for that. So it'll be really, really freaking awesome just to kind of stand for a bunch of good causes and have the opportunity to do that.
You're cool. A celebrity. Awesome. Cool. No. Not because of this webinar. I mean, because of this webinar.
Yeah. Oh, and thank you, Carol. Thank you for your prayers. Okay, so enough of the personal. I just know that for a lot of you that have joined us, you're kind of getting to know us, and it was right in the webinar that I had to jump off the call. So I just wanted to kind of share a little bit of my life. And so thanks you guys for just, riding along with us. So Patrick, since I wasn't on the recap, at the end, I'll let you recap and what we're going to jump into. One of the things that we're going to work on next week, though, is how to build a wealth strategy. So I'm really excited about that because, believe it or not, Patrick and I have very different inputs on the wealth strategy building. I have, from a cash flowing multis to appreciation assets, and how and when to utilize both and know the pros and cons of both. How do you take your client from not having a lot of capital to helping them leverage into more capital and expand their opportunities. So next week, we're going to work on wealth building strategy so that you can create a picture. And every time I help a client, I kind of feel like I'm giving a diagnosis. Every time they tell me, like, this is my goal and this is what I want. And the only way as a realtor you can know how to give them options is if you know what they are, if you create the path for them. Okay, so next week we'll focus on wealth building strategies, and Patrick's got more on real estate financials this week based on following up on last week, so I'll let you recap and lead with that, Patrick.
Yeah, thanks. And last week we covered a lot of like data-driven numbers. Today we're going to dive into some real estate financials. Specifically, I'm going to help train everybody. If you're buying or selling, helping a client with an investment property, really a 2 to 4 unit, sometimes even a single family home, how do you value that property? How do you input the correct numbers into the MLS? Because we see a lot of errors there. Again, though, if you didn't see last week's, take a look at it. I'm a very data-driven agent, and that's how I've been able to secure so many clients in the last few years, by sharing data with consumers. So if you want to grow your client database, my number one recommendation isn't so much putting photos of yourself all over the place, but putting data all over the place. And the consumers in your marketplace will see you as the agent that knows what's going on in the market. And I've been able to grow my business to, I'm really only about 3, maybe 4 years into this now. And we're closing over 100 transactions this year, just because I've been sharing that data. So share data with your consumer. With that, though, let's transition into a very specific form of data, real estate financials on an investment piece of property.
And you know what I'll say just before you even get started on that, like, guys, this is what makes you different than everybody else. Okay, we can be salespeople. I am not a salesperson. It actually, to me, is irresponsible of our community to be salespeople when we deal with financial investment assets. And we are one of the few, we are the only financial licensed professional that doesn't actually have a finance license, right? Yeah. And so we're dealing with people, with their money, with their investments. And so understanding the economics, the data, the investments, the dollars, like, that's what makes you a skilled professional. Obviously, aside from being a contract ninja and knowing your negotiations and knowing how to hold leverage in a contract, that's your skill as a real estate professional. Negotiations, leverage, being super crafty there, the way you write all your clauses and terms and all that stuff. But the other side of that is your numbers, your data, your finance. That's what makes you head and shoulders above any other real estate professional. And so that's why we're hosting this, to really help you get the right mindset, tools, and all of the aspects of how to create the picture to be really, really skilled in this profession.
Yeah, that's a great point, Vanessa. And I love how you draw the analogy between real estate as a financial profession, yet we don't require financial certifications. And if you go invest into a stockbroker, if you walk into like an Edward Jones, or you talk to someone at Fidelity and you just want to invest like $6,000, the person you're talking to has to have financial certifications.
They have licenses.
With us, you want to buy a $600,000 home? Great. We don't need any financial certifications. We just need a real estate license, which is crazy.
It's insanity.
Yes. So especially if you're, even if you're helping just a home buyer, but especially if you're helping investor buyers. And if you aren't now, you eventually will be within your real estate career. So with that, Vanessa, you mind if I jump into a PowerPoint so we can look at some financial formulas? All right, I'm just going to share my screen so everyone can see and look at the same thing here. Can you see the screen, Vanessa?
Yes.
All right, so let's dive into it. This is an MLS sheet. I don't know if they look the same in your market. They probably look similar, if not exactly the same. But we're going to end with this sheet. I wanted to start with it to show you, at least in my market, likely yours, what an MLS sheet looks like for a 2 to 4 unit investment property. We have all this information here at the top, such as the location, the price, the number of units, how many days on the MLS. And then down below, we've got the directions, what are the terms of an offer that's required. At the very, very bottom, the MLS buries in the financial data. Now, if you're buying a stock, if you're buying a bond, or if you're out there buying a major real estate investment product, like a commercial property, this financial data is going to be at the top on page 1, because an investor wants to know, what are the numbers? Show me the numbers. But in 2 to 4 units, we bury it at the bottom because, unfortunately, most residential agents aren't even skilled at being able to calculate or interpret this data. So by the end of this 60 minutes,
a lot of agents will jump into multi and smaller multi, and don't get me wrong, your first time that you're selling a smaller multi, or helping a client buy a smaller multi, it's going to be your first time, right? So that's why I'm glad you're staying in this class, so that we can show you how this breaks down. But I'll tell you, when a random agent just lists a multi and they don't put the financial data, the operating information, you could tell the difference between real estate professionals who know what numbers are valuable and those that just kind of like are winging it.
A lot of times this data will be blank, Vanessa. A lot of times it will
and
be
that's
blank.
how we take advantage of it, and we get good deals because the other agents don't know what they're listing.
That's right. It'll be blank or it'll be wrong. So I used to work in commercial real estate before residential. And when I walked into residential, I looked at all the MLS sheets for 2 to 4 units, and I saw they were all blank or wrong. 90%. I laid out over 200 MLS sheets, and over 90% were blank or wrong. And
Only you would do that.
Yeah, I did. Like, it was Saturday morning, 200 MLS sheets laid out on my living room floor, and I had sticky notes, and I went around with sticky notes. And this is one of those MLS sheets from 4 years ago. Actually, 3 years ago. It was 2017. 3 years ago, and I did all this handwriting on each and every one to correct the errors. You can see a close-up of my handwriting, and by the end of this webinar, you guys are all going to be able to calculate this yourself. That is a goal. If you walk into a listing appointment for a duplex and you can show these calculations accurately to a client, you will get that listing. And when you work with buyers, if you can help them with this, you'll win every buyer. So let's go over some very basic real estate financial terms, and then we'll get into some calculations. So definitions first. Gross rent, revenue. Both words interchangeable. What is gross rent and revenue? It's just simply all annual income before subtracting any expenses. So if I'm renting a property for $2,000 a month, my gross rent is $24,000. That's how much you're getting in a year. Next term, operating expenses. Operating expenses, also abbreviated OpEx, is simply all expenses for a property. Keep in mind though, it does not include your mortgage payment. Why does it not include mortgage payment? Because a mortgage
variable.
payment is exactly, variable. Because Vanessa, do some people buy property all cash? Of course they do. Most don't.
And their cash on cash return changes, right?
Yeah, so your OpEx does not include your mortgage. A mortgage is not specific to a property because each buyer could have a different mortgage. But the OpEx is specific. So what's included in that? Maybe your water bill, maybe your landscaping bill, your tax bill, your insurance bill,
everything that's static, that is pretty much static.
Absolutely. Now, as a gross rule of thumb, let's say you're looking at a property and you don't know what the operating expenses are. Operating expenses, as a rule of thumb in real estate, are typically around 35% of gross rents. If it's a well-managed property, they're usually around 35%. The least I've seen them is around 30%, and the most I've seen them is around 40%. So if you just know the gross rents, but you don't know the operating expenses because you haven't seen the prior year's tax returns and all the expenses for that property, use 35%. I also advise clients that if you're going to manage it yourself, your OpEx will usually be closer to 25%. Why is that? Because property management expenses are typically 8 to 10%. So you manage it yourself, usually around 25%. Next, net operating income. Net operating income is simply gross rents minus operating expenses. And that gives you your net operating income, NOI. Why is it called that? It's your net of rents minus your expenses. So after all operations, a very important term, NOI. Now, beyond these, that's really the only three inputs that you need to calculate our value indicators. So what are value indicators? Well, let me draw an example. Let's say a stock, I could tell you, hey, this stock has a 7% return per year, or has a 4% return per year, or has a 3% dividend. Those are value indicators for stock. For real estate, we look at something called a cap rate. Cap rate calculation is really simple, and I'll show you the numbers in a minute, but a cap rate is simply calculated by dividing your net operating income, NOI, divided by your purchase price, whatever that value is. I put up here as by way of example, in San Diego, we often see cap rates between 3 to 6%. In your market, you might see cap rates higher than that, lower than that, or right on par with that. But that cap rate, let's think about it for a second. If I bought a property that's getting $100,000 in revenue and it has $35,000 in operating expenses, my net operating income is $65,000 then. And if it's $1 million property, $65,000 divided by $1 million is 6.5%. So that's how you calculate cap rate. The other value indicator is called a gross rent multiplier. This term is not as common as cap rate, but it's just as important. It's widely used term in real estate. It's always used in commercial. So what is gross rent multiplier, or GRM? It's simply a number calculated by dividing the purchase price by the gross rents. Now, and I'm going to break that one down into a formula. It's nothing here is beyond division and multiplication. It's like 7th grade math level. But I want you to know that gross rent multiplier, I always like to say the lower, the better. Cap rate, the higher, the better. So how do you memorize that? GRM, think of it, it begins with G, and so does golf. And in sports, with golf, the lower the score, the better. With GRM, the lower, the better. Cap rate, the higher, the better. So let's get into some real examples. Anything you want to mention or add about these definitions, Vanessa, just feel free. But I want to jump into some numbers so we can kind of put this into practice. So real estate 101, you're buying a fourplex, it's $1 million. Easy math, $1 million. Let's say your gross rents are $76,923. Why'd I come up with such a specific number? So I can do some easy math coming up here. So gross rents, no expenses taken into account. Once we take into account our expenses, notice I use 35% of my gross rent as an expense to calculate my OPEX. My expenses are $26,923. Now, if you're helping a seller sell a property, you're going to walk into that appointment and you're going to say, hey, can you show me your last year's tax returns? Can you show me, if they don't want to give you that, say last year's records, profit and loss statements. Show me your profit and loss statements on that fourplex. And they should be able to show you their profits, their rents, and their losses, their operating expenses, so that you can come to this calculation, net operating income. Now we see here that once we subtract the rents from these operating expenses, which again are things like taxes, insurance, property management, maybe your water, landscaping bill, we get to a net operating income of $50,000. So now that we know the NOI, nothing beyond subtraction here, the NOI can give us the cap rate. How do we do that? NOI divided by the purchase price. And remember, this was $1 million property. So $50,000 divided by $1 million is going to give us that 5% cap rate. It's as simple as that. So subtraction and division. That's all you got to know. The main thing you need to get the info for, though, is what are your rents? What are your expenses? Let's do some math. While I'm on the screen too, the other thing I want to mention is cap rates are typically market specific. So there's certain, I can tell you about my market and, you know, apply it to your market, but in San Diego, we have certain zip codes, certain neighborhoods that have a 5% cap rate. I have certain neighborhoods out here that have a 6% cap rate and certain neighborhoods that have a 3% cap rate. Lower cap rates are usually going to be in better neighborhoods. Higher
And the reason why, and what I love to explain about this is that typically, you know, the reason why your cap rates are going to be lower is because the property value is going to be higher, and the margin between your rents and the price of the property essentially is going to be slimmer. However, those homes will typically appreciate better and hold value better. And so there's some intrinsic value to the real estate, especially when it comes to tax deferment, where, you know, obviously you're not paying taxes on an appreciating asset versus, you know, when you are paying taxes on your cash flow and you have to report that on your K-1 for that property. But so that's what he's referring to, is typically your cap rate will seem lower in a higher value asset. So it's common.
That's a great point. And I think, Vanessa, we discussed the tax webinar a bit ago. We can always do that one again too. But Vanessa's absolutely right. Like your money you're making on that cap rate is typically a portion of it going to be taxed. It really gets deep. And your money you make on appreciation typically is not going to be taxed, at least not right away. So your cap rate, one thing to note, your cap rate plus your appreciation rate is usually going to equal 9% plus or minus 1. So somewhere from 8 to 10%, no matter what market you buy in. So if you're buying in Toledo, Ohio, Fargo, North Dakota, New York City, or San Diego, or Anchorage, Alaska, no matter where you buy, if you add up the cap rate plus the rate of appreciation, it's going to be around 9%. Now, I told you that the higher cap rate, the better. Yeah, 2 properties in the same neighborhood, same condition, right next door to each other, the better. But I would rather buy a property right by the beach with a 4% cap rate than a property in the middle of nowhere with a 5% cap rate, because obviously the one by the beach might appreciate a bit more. Additionally, me personally, I tend to invest in lower cap rate properties that have higher appreciation rates. And we can get into that when we talk taxes one day. But I really just want everyone to be able to understand how to calculate the cap rate on a property.
And I'm sure anybody who's on this call, you know, you probably listen to Bigger Pockets. If this webinar is an interest to you, you probably have heard a lot of different theories, philosophies, and Patrick is typically in data, really, when you look at trends over years and years and years, like from the origin of this country and the origin of real estate, that typically the average of your cash flow and your cap rate will equal 9. And so that is a financial constant. And so you'll hear us talk about that quite a bit as we explain these concepts. And Patrick will sometimes reference K. So K is that constant of the that cap rate and that average of 9%. And that is in another webinar video that we did probably week 2 when we started this. And just for those that kind of jump in here and say, hey, I didn't see the videos, where can I watch them? We will be restarting this financial webinar series in sequence, so that way you can jump on and re-listen and revisit, and you can hear it in a more dynamic way, because I know, you know, it's not the same when you just go watch videos. It just isn't. So we're going to restart this so that way this can be just an exposure class to you, and then we'll restart breaking down financials and why we get the values we get and what we're talking about.
Yeah. And another thing, as a realtor, when you go in and you're getting a listing, you might say, well, I don't know what the cap rate is. I know what the seller wants to sell it for. On this example, let's say the seller wanted to sell the property for $2 million. and their net operating income is 50K. Well, you and I both know that would make their cap rate 2.5%. And you look all around the neighborhood, and all the other property is selling at a cap rate around 5%. Your property is not going to sell. You need to sell the property at a similar cap rate to the neighborhood, or it's just not going to sell. On the other spectrum, let's say the seller tells you they want to sell it for $500,000. I would come in and say, you want to sell for $500,000? That would make your cap rate 10%. And this is a 5% cap rate zip code, 5% cap rate market. You don't need to sell it for 500K. We can sell it for $1 million. So this helps you to advise your client to get the value, the list price accurate. Don't overprice it, don't underprice it. Market value. The next one, GRM, gross rent multiplier. So when do we use gross rent multiplier? Well, as you just learned, to calculate cap rate, you need two things. You need your revenue and you need your expenses, because you need revenue and expenses to get to net operating income. Now with GRM, you can calculate that without knowing the expenses. When would I want to do that? Well, let's say I'm working with a buyer and I look at a property and we don't know what the expenses are yet because we haven't seen last year's profit and loss statements from the seller, but we know what the rents probably are and we know what they want to sell it for. So we can now calculate gross rent multiplier, because gross rent multiplier is simply the purchase price divided by those gross rents. And this is another term often used in real estate to give an indication of value to a property. So in this example, the GRM equals that purchase price, $1 million, divided by the gross rents.
That's the annual gross rents. Mm-hmm.
Annual, yep. Divided by the annual gross rents, and we get a gross rent multiplier of 13. Now, sometimes you might see a gross rent multiplier of like 150. And you're like, how'd they get a gross rent multiplier of 150? What they're doing is they're taking the monthly rents and dividing that into purchase price. Appraisers often take the monthly rents and divide it into purchase price. Real estate investors, 99 out of 100 times, will take the annual rents divided into purchase price.
And most of the time you want to talk annual rents because I mean, monthly rents that just gives you a very too small of a blip. You know, you want to talk about your annual volume against your annual cash and what your annual investment is. You really want to talk on annual terms when it comes to investment properties.
That's right.
And you know, even when you're talking to your clients about these investments, and even if they're on the conservative side, what I'll tell you, because if you're in a market that doesn't have like these cash cow flowing kind of multis, and if you have a client that is very like cash flow focused, and especially those people are usually new in real estate, just FYI, cash flow focused investors are newer in investing typically. So, because they're trying to collect capital. But what I'll say is that I always tell people, you know, this is not a get rich quick scheme. No. Like when did you ever invest in an IRA and expect to get rich overnight? When did you ever buy a piece of even Apple stock and expect it to turn into like $1 bazillion overnight? You know, we don't do that with any other financial asset, and then people think they're going to jump into real estate and then like it's going to just be magic, right? No, this is not a gimmick. This is not magic. Occasionally you'll get an opportunity on a wave of appreciation that you can resell assets for large volume, but this is a consistent, tried and true proven way to measure real estate and to look at the numbers.
Yeah, I think I mentioned a couple of months ago, Vanessa, I bought a fourplex half a block to the beach 2 months ago, and I am negative cash flowing $1,000 a month. Why would I buy something that negative cash flows $1,000 a month? Because it is appreciating $50,000 a year.
$4,000 to $5,000 a month.
Yeah,
no. And Patrick is in a different financial position. My young military members that I get into multis definitely can't afford to be negative cash flow $1,000 a month. They would just be red all the time, right? So everybody is in a different position, but he is purchasing an appreciation asset, which we'll talk about the difference of those next week when we do the wealth building strategies. We'll talk about that. That'll be a great example, because sometimes you're focused on cash flow, sometimes you're focused on sheltering your cash flow.
Yeah.
So we can talk about the different strategies and to make a full holistic picture for your client.
Yeah, and
Didn't mean to interrupt you with your GRM.
No worries. That's a good point. I am in a different position. I don't think everyone should do what I did. Maybe if they're starting out, they should do what I did when I was 27. I'm, a decade and a half older now. And when I was 27, I was looking more for the cash flow as a young guy in the military. And not only cash flow, I was buying places, living in them, house hacking, right? Had roommates, that type of thing. So when you're young and just getting into it, you don't want a negative cash flow $1,000 a month. But as you start,
or even if you're old and just getting into it, if you're just, because I always tell people, like, I could put you on a plan to retirement in 5 years. Give me 5 years, a couple of mixed up strategies, and you'll get into a cash flowing position.
Yeah, but and this is why it's important to be, when you're a consumer, working with a well-informed realtor, and when you're a realtor, being well-informed. And knowing that no box fits everybody, knowing how to do the various numbers. Yeah.
It depends. It depends on their capital, depends on their family, their lifestyle, all of those variables. Can they use conventional loan products? Do they have to use creative investing? Everybody has a different investment formula. And so that's why, as a real estate professional, that's why we're having these conversations, so that we can really kind of learn about them. And speaking of which, I'll use this segue and interruption to say, I did get a question on Facebook that says, how do I brand myself as an investments focused agent? How do I get in front of investors? And so what I'll say to that is, so I had to get organically, genuinely passionate about doing my job harder than every other real estate professional. I had to refuse to be a Vanna White realtor and just go open a bunch of doors and say, do you want option A, B, C, and D? Let me write up that contract. I had to say no on a buyer's consult. I won't go show you homes, because I have to explain to you all of these options that you have so that you can create a financial picture for your life. And they would tell me, Vanessa, I came to you to buy a house and now you're making me plan my life. I'm like, exactly. So go plan your life, come back, and let's create a strategy together. So I had to put a foot in the sand to say, I know I sell real estate harder, but I can't do it any other way, because this is the only way that I truly believe that I can be of service to my clients, is through proper education and teaching them how to build wealth through real estate. So I had to take, when we talk about how do you brand yourself, like, I'm not in investments to like be cool. Okay. I'm in investments because this is how I believe that our opportunity to serve our clients in real estate investing really changes lives. And I believe that on such a fundamental level. So I never had to fake brand myself, right? People know, as your reputation grows as a real estate professional, people have grown to trust me and to listen to what I'm saying. I actually got a Mother's Day wish that said, Happy Mother's Day, real estate mom, right? And I mean, literally. So people really, and so when you grow organically like that, because you come from a conviction of wanting to provide like really, good value to your clients, that's really how you get, like how you start your reputation, which will lead to your branding, is get smart on these principles, understand what you're doing. And then one way to get in front of investors is to go to investor meetup groups, go to investor seminars, go to multifamily seminars, follow the Rod Cleef stuff, all of those people that are in commercial multifamily investing, read all the books. Whenever we host these investment seminars, my investor partners like Patrick and all the other guys on active duty passive income, they start with a list of 12 books that they all read to learn this stuff. You know why? Because there's no school teaching us this. We all had to like learn in the school of hard knocks. And so, it's literally a list of books that everybody reads. So learn this stuff, get in those investment groups. You'll meet a ton of investors. Your network is key. And that is how you grow into being an investment focused agent.
Yeah. And you mentioned, Vanessa, go to investor meetup groups. Right now it's tough. It's kind of webinars, right? But I would say also another thing you can do is create an investor meetup group. When I got into real estate, I had never been to an investor meetup group. I didn't know what they were, but I created one and I put it on meetup.com, and I had 3 people show up. This was in 2017. 3 people showed up. and I did the exact presentation I'm doing right now. It was like an hour and a half, so I went a lot further. But I just showed them this data. And then I did it again the next month and I had 6 people show up. And then the month after that, 10 people showed up. And it started spreading word of mouth. And now I had gotten to a point where I have 20, 30, 40, 50 people show up at these investor seminars I do, and I'll get 1 or 2 or 3 escrows out of it. So
right, and me too. My home buying classes are all investment focused, and I mean, at the end of my class, I talk for 2 hours, and it's every single class. People will just stay and sit, and everybody's waiting to see who's going to come up and talk to me first for another 2 hours usually. And so this information is so life-changing and shifting for your clients. It will organically start to grow when you learn this, when you get passionate about it, and when you preach it to your clients.
Yeah, all this stuff that Vanessa and I are teaching you, use it, take it, make your own slide deck and teach it to clients, teach it to strangers, and they will become your clients because they'll see you as that expert.
Mm-hmm. So GRM, sorry.
Yeah, go on.
No. I said, so GRM, you were talking. Sorry, I interrupted you.
I wanted to get back right where we began here. Here's the MLS sheet. So we've gone through and for this 60-minute, Vanessa, as you know, I wanted to just go real basic, break it down. What's a cap rate? What's a GRM? How do you work with a client with these numbers? So here we are, back to where we began, folks, the MLS sheet. And I mentioned most of these. I challenge each of you to go into your MLS, look up 2 to 4 units, and go down and look at all the calculations that agent might have done. And then you do the calculations and tell me, how many do you find that are blank? How many do you find that are wrong? And I'm telling you right now, over 90% most likely. So let's look at this example. I blew up in a large size here, the financials that were at the bottom. This is a duplex, unit A, unit B. And we see that they wrote in the actual rents, $1150 and $1250. That's one thing I'm going to believe. The 2 things on this sheet I'm going to believe, because it's really hard to get wrong, is what price do they want to sell it for, and what are the actual rents. So we see that the actual rents come to $2,400 a month or $28,800 per year. To the right, you always write in the projected rent. Another term for projected rent is pro forma rent. You'll see that sometimes too. And that's just what are the rents if you increase them to market level. So market level rents are $1,350, $1,550, which is $2,900 a month, or what is this, $34,800 per year. So now that we have all the inputs we need, we can do those 2 calculations, cap rate and gross rent multiplier. Down here in the bottom left, they put gross scheduled income and gross scheduled income projected. As you notice, they put in the monthly amounts. That's okay, but they shouldn't have. You should always put in, as Vanessa mentioned, your annualized amounts. You want to know, what have you gotten for the last year? And what are you going to get in the next year? Because maybe they just bumped rents all of a sudden artificially, put in a 1-month-long tenant. So this write-off told me this agent, they know how to calculate the monthly, but they probably don't do a lot of these. Next, gross rent multiplier. They put in 15. I calculated the gross rent multiplier, and you can at home if you want to, and I come to 14.23. Now, the 15 that they put in, as you know, gross rent multiplier, GRM, is like the game of golf. The lower, the better. So as a buyer, I'm looking for these low GRMs. As a seller, if I want to sell my property, I want to advertise it with that low GRM to make the property look more attractive. I don't know how this agent got to the number of 15. My only guess is that they probably got the 14.23 as well, and then they rounded up. But by doing so, they did a discredit to their seller, and they're not marketing the property for the seller as good as they should. Next, over here on the right, this is where the big mistakes are starting to happen. On the right, they put a net operating income of $236. Again, my guess, I don't know how they got to that calculation, to be honest with you, because we know their monthly rents are $2,400. So they're indicating, even if they're going off a monthly level, they're indicating to us that their expenses are over $2,100 a month, which is insane and not true. I'm telling you, this person just did some miscalculation. Nobody would buy a property for over $400,000 that has a net operating income of $236 a year or $236 a month. The projected ones are even down in the hundreds, 636. So what did I put over here in my pen and ink? I did the net operating income based off of the gross income and calculating in a 35% expense ratio. And I get to an NOI, net operating income, of $18,720. And on the projected rents, if you bump the rents up to market level, $22,620. So this agent is really misrepresenting this property in a horrible way for their client, because again, nobody's going to buy something with a net operating income of a few $100 a year or even a few $100 a month if it's over 400,000. This, in my opinion, is worthy of a lawsuit. I'm not an attorney, but I'll tell you right now, this agent is misrepresenting the property, misrepresenting the seller, and making the property look worse than it actually is. If I was the seller and I watched this webinar, I would probably look back at and I would call an attorney and I would say, why did they so grossly misrepresent me? Now, why does this happen? No, I'm telling you, 90% of MLSs are going to have bad calculations like this because MLSs do not monitor this. They don't track it. They don't slap people with fines or.
Well, because no one knows this information.
No one knows how to calculate. No one working at your MLS office probably knows.
And because there's not a license in finance to be a realtor. That's why. That's why.
Yeah. I'm telling you, if I wasn't an attorney, that's Freudian slip. If I wasn't a realtor, I'd become a real estate attorney, and boom, it is ripe with lawsuits because they're especially in the 2 to 4 unit. But I'm not going to become an attorney because then I'd be suing all my brothers and sisters in arms, us realtors. I'll stay a realtor. Don't worry, guys. But I want you guys to know how to do this right so that you can get your listings, you can work with your buyers, and so that you don't.
And you can be the best at this. Like that's like the beautiful thing is that since everyone doesn't know, you can be the one who does, and you'll be like, it's like the 2% of people that in this industry that understand this on even a fundamental level, forget mastery, right? So
absolutely.
So yeah.
And guys, I never learned this as a residential agent because they don't teach us residential agents this stuff. Because how many 2 to 4 units do most residential agents sell? Not many. I learned this when I worked in commercial. I worked in commercial just for 1 year, and then I went to residential. But that 1 year in commercial was invaluable because I learned how to do this. And now I share it with my team. When I walk into a listing appointment, I have a folder filled with these, marked up just like this. And I show it to the seller, and I say, hey, Mr. Seller, look how most agents do the math. Look how they do these calculations. They do it wrong. We will do it right for you so your property is marketed correctly. And I've never sat down for a 2 to 4 unit listing appointment that I didn't get the listing on because I show them this. So you, whatever market you're in, do this as well, please. Do this as well and walk into it with your listing appointment. Last but not least, I want to show you on the right the cap rate. The cap rate for this property, they put 23%. And on the pro forma, the projected cap rate goes down to 18%. In what universe do you buy a property, raise the rent, and your cap rate goes down? That is completely backwards. When you raise the rent, your cap rate's going to go up. So this one I circled in red because that's probably the biggest flaw. All these are flaws, but this is the biggest one. Cap rate's not going to go down when you raise rent. So on the right, you see in my pen and ink again, I calculated the cap rate to be 4.56, and that's simply by taking net operating income, excuse me, divided by purchase price, and the cap rate projected is my projected net operating income here, $22,620, divided by the purchase price to get to a cap rate of 5.51. Now in San Diego, this is a good deal. This is a great deal. I'd buy something with a 5.51 cap rate. Now, a cap rate of 18 to 23, you're not going to find that anywhere in America. That is cap rates in America, as I said, usually 9% or less. So there's just so many egregious errors on this. You can even see down here my little financial calculations I did in pen and ink. So with that, I'm going to kind of close it up on this MLS spreadsheet. But if there's one takeaway you have, watch this video again, learn how to do cap rates, learn how to do net operating incomes to get to that cap rate, and learn how to calculate gross rent multiplier. And before you go on a listing appointment for a 2 to 4, or even an a buyer appointment, print off 2 or 3 of these, chicken scratch it all up, put in your pen and ink, make the errors correct, put in the corrections, and share this with the seller, share this with the buyer to show them that you're an agent above and beyond the other agents that they're meeting with, and you know how to do these calculations correctly. With that, Vanessa, I'm going to stop sharing this and we can kind of just converse. And I see some questions coming in, I think.
Yeah, let me see. Yeah, so there's quite a few.
Let me see
Do you use current taxes or calculate to future taxes? I always use current taxes, and maybe I look to see if where there's going to be a big tax bump. Typically, if it's new construction, you want to be aware of that. But I typically will use consistent taxes because I don't try to project like I know the future. But what do you think, Patrick?
That's a good question. So sometimes folks use current taxes for the gross scheduled income actual. When doing the gross scheduled income, not the gross, but the net operating income, when you're subtracting taxes from gross to get your net operating income, the projected, you must use projected taxes, okay? Now, sometimes I see people do the actuals on the actual taxes. However, the way it's done in the commercial business and investment business is you use the pro forma taxes, i.e. the new taxes based on the new purchase price, because when you buy at a new purchase price, higher purchase price, your taxes reset based on that new purchase price. You should use those new taxes on both the actual net income, net operating income calculation, and you should use those new taxes, of course, on the projected net income calculation. Why? Why is that? Because we want to compare apples to apples. I don't want to compare apples to oranges. And when you buy a new property, to compare your current NOI and your pro forma NOI, you're probably going to have similar water bills, similar insurance bills, maybe similar property management bills might start to trickle up once you trickle up those rents. But you want to have the same tax bill reflected in that NOI calculation. So to answer the question, I always use the new tax basis, the new tax cost for the new buyer when calculating both the projected NOI and the actual NOI. Because when that new buyer buys.
So you use, when you say the new taxes, for example, like I will look at, I mean, I use what it's available, but what formula then do you use to project the taxes?
Oh, well, so what formula do I use? I use purchase price times 1.25% equals annual taxes.
Oh, so you just use the rule of thumb, not what you, okay, I see what you're saying.
Well, I use that because in San Diego, our taxes are about 1.25% of purchase price.
Right, so it's going to change per market.
That's right. In your market, know the real estate annual tax rate.
Yeah, and see, we have so many different mill rates in our community, and like taxes in like 30 minutes where I also sell real estate, they like theirs are like half the value of Anchorage. So we have so much like change, like so much variables that I that's why I go by my actuals, because it's just, you know, there's too many variables for me.
Yeah, definitely in your market, know that tax rate. And in San Diego, our tax rate goes out to like 6 decimals. It's 1.17 and then a ton of decimals. But then we've got school bonds and other municipal bonds that make the average property in San Diego have a tax rate of 1.25. And that tax rate is based off the new purchase price. And that's why I use the new purchase price to calculate the NOI, the tax basis, to get to the NOI for both the actual NOI and the pro forma NOI. In fact, I can pull up an example of what I use when I'm calculating for a seller.
So I have a question. This is what made you want to switch from commercial to residential. Okay, so this is from Maybell. she's basically saying, and I'll touch on this for a second, and you can touch on this also, Patrick. So, and it's kind of funny because my history with real estate specifically, I've never focused on commercial. I learned multifamily because my market has a lot of 2 to 4 units. And so I started teaching veterans on how to use their VA loan, on how to leverage their VA loan to gain passive income. So I got super skilled in multifamily, and I sell about 50 to 60% multifamily a year, just because the nature of where I started real estate and the financial input and my military intelligence kind of background, was just basically research, just kind of made me a really weird unicorn in my market. But Patrick converted from commercial to residential, and she's saying, what made you switch?
Yeah. Okay. And let me get to that. What made me switch? That's a longer answer. So let me answer a couple of real quick ones too. I see that have a few people confused in the chat. The short answer though, opportunity. If I put it in one word, opportunity. The couple of questions I want to knock out in 10 seconds, and then I'll answer the full version, is, do I have a program to input NOI, GRM, cap rate, spits it out? Yeah, I got an Excel spreadsheet. I'll show you in a second. Another person's saying, did I say that taxes are 1.25 times purchase price? No, taxes are 1.25% of purchase price in San Diego. In your market, it's different. If it is 1.25 times, you'd be paying more than what you bought the property for every year in taxes. 1.25% is going to come to 0.0125 times the purchase price.
Go ahead.
And the another person says, is taxes included in the 35% expenses? Yes, taxes are included in 35%. Every single expense known on earth to God is included in that 35%, except not your mortgage payment.
But in a mortgage payment for like a VA loan, taxes are included in your PITI.
Yeah, but when you break down your investment property,
your spreadsheet, you pull it apart.
Yeah, PI. We always talk to clients. PITI together is an investor. PI is one thing. TI is another.
Okay, got it. And then really quick, you guys, I know a lot of people ask for these spreadsheets. We are building a platform as soon as I get settled, and we are going to do a 2-hour tax crash course. It is going to be a paid course. It'll probably be somewhere around $50 because we want people, this is a lot of it's content, a lot of education. I mean, Patrick has been in school. He has 2 master's degrees for an entire decade. So the value of knowledge set that we have, we want to make sure that people that are joining us on these webinars actually have skin in the game. So we did get permission to do that. So we will be building the platform to have the resources, the tools that Patrick has created, as well as the paid course for you guys to jump in on, so that way you guys can really get more information. And go ahead, Patrick, show what your calculation is.
Yeah, this is a spreadsheet I built a few years ago. Again, this ties into why did I leave commercial and go to residential. Guys, commercial, it's all about cold calling. In commercial, there's a lot of sharks. I'm not saying sharks are bad. I've got a little sharkiness to me too. Like, sharks are out there to get the deal done, to get business done, right? And would you rather be a shark swimming with sharks or a shark swimming with guppies? I'm not saying residential agents are guppies, but that's the analogy I just used. Apologize, I'm a residential agent too. But I'd rather be a shark swimming with guppies. He's more
skilled than the average residential real estate, so he can stand out, right? This is exactly what I said to somebody when I came to Alaska. I fit in more with Alaskans, but I stand out more with Alaskans.
When you just won Miss Alaska.
Yeah, and so like when I'm from California, right? So yeah. I kind of, even though I look a lot like a Californian, I'm Latina, I grew myself like a girl, where I'm not like, super granola, like a lot of like people stigmatize Alaskans, which it's not necessarily the truth, but I'm very much a tomboy. I'm down to earth. So I love the Alaskan culture. and I fit in. I feel more at home there, but I stand out, right, like a sore thumb. And so when with him, it's like I fit in residential real estate. I'm comfortable here. These are my people, and I'm also more skilled than the average like residential agent.
Yeah. I love your analogy, Vanessa. And that's exactly it. You answered the question for me. Thank you. But in commercial real estate, all this knowledge I'm sharing with you guys right now, it's a dime a dozen in commercial. Everyone in commercial real estate knows these calculations inside out, backwards, and forwards. Very few people in residential do. So when I left commercial and I saw the opportunity, I looked in business school. I learned if you want to make a lot of money, find an opportunity where you can stand out, or find an arbitrage situation where you can provide value that isn't there. And I looked at residential. I saw most people don't know this stuff. So what if I go into residential, I use it. Now, my first full year in commercial, I made very, very little money, close to darn near zero, because commercial is a long sales process. It's nothing but cold calling.
It's like a year to buy a freaking building.
It's a year, yeah. And I was there for a year. So guess how much I made? I went to residential, and as soon as I went to residential, I started selling a property a month. 6 months into it, I was selling 2 a month. Now I'm only 3 years into residential, guys, and my team and I were going to close probably about $60 million in real estate in 2020. And this is my 3rd year in it. And I started out as a one-person show. Now I got a team of 11 that I grew in 36 months because I brought this knowledge to a different ballgame. And the other analogy, forget about the Sharks, but if you're qualified to play basketball at the NCAA level, you're good enough to play the NCAA level, and then you go play basketball against a bunch of like high school kids or 8th graders, how much are you going to stand out? You're going to stand out as the MVP. If you go play NCAA, you're going to look like just everybody else. So I'm not saying bat in a league below you, but if the league below you pays well, bat in a league below you. Okay. And residential real estate, 2 to 4 units can pay well. So I could work in commercial.
But you know, for me, I'm in it, and what I'll say is because I love to help people change lives who started with nothing.
Yeah.
You know, I love to take my veterans, and I mean, Patrick and I are both service members, and I'm still in the Alaska Air National Guard. And what I'll say is, like, I could take a fixed income E2, E3 and teach them how to build their life. And that is what I'm most passionate. That is why I sell residential real estate, because taking people who, especially service members who come from a background of maybe being a lower socioeconomic, and helping them teach them these fundamental principles that change their life, to me is the reason why I do what I do. So that is my passion.
You nailed it on the head. And I have so many like phrases. My other phrase that ties into that is, when I worked in commercial, my job was to make millionaires, multimillionaires, and multimillionaires decamillionaires. Now that I work in residential, I take so much more enjoyment out of it, because my job is to help simple people become millionaires. And by simple people, don't let me belittle that. I'm a simple guy. I'm like, I did a family vacation, and I went camping. But I love helping that E5, that O1. We just helped an E5 go out and buy a 4-plex. He's living in it. The other 3 units are 100% paying his mortgage, and he's still making $600K a month on top of that. That's the client I like to help. And that E5 is going to be a millionaire one day because he bought that 4-plex. So I get so much like just pleasure out of my job by helping folks like that.
Absolutely. Me too.
This thing in front of you.
What?
Well, I'll end it real quick on this because I know time. But this thing in front of you is something real simple I built a couple of years ago. And all I got to do is type in blue what the purchase price is, what's the actual rents, what's a pro forma, and what's my expense ratio. And then my cap rate, my GRM spit themselves out in green. So this one, I had a guy managing the property himself, so he used 25% expense ratio. Now watch, if I put in 35%, got a property manager, boom, cap rate just changed. Why did GRM not change? Because GRM doesn't take into account expenses. Only cap rate does. See how the cap rate just went down? Actual pro forma. Let's put it back to 25. Boom, just went back up. So this is a really cool tool. I can change the purchase price. And there, all 4 change because GRM does take into account purchase price. I can change the rents. And again, actuals just changed, not pro formas, because I just changed the actual rent. You guys saw that? So I created this little tool a couple of years ago, and I use it within my team. Real simple to use. And if I know, this is if I don't know the expenses, then I got to use like 35% or 25% or 30. If I know the expenses, well, that's tab number 2. I go to tab number 2, same thing. I got my cap rates, my GRMs, purchase price. Down here, I've got expenses broken up. So folks, here's those main expenses that you're going to use in your operating expenses: taxes, insurance, utilities, repairs, maintenance, management fees, and reserves. So just cool little stuff that I built to my team. And if you're able to do this, I'll probably go deeper into this, Vanessa, when we teach that class, and we'll do a deep dive into these spreadsheets, I think.
And guys, we'll plan for this class probably end of September, just because we want to make sure to market it correctly. Patrick has a lot of this already built, but we just need to package it. And so we'll plan for end of September, and we will make sure that everybody who's been on our webinars will get emailed to register for that. And we're excited to just help, bring that education and value to our fellow real estate professionals, so that we can affect more and more people, as we help them at the closing table. So yeah. Cool. Well,
I think we covered a lot of good basics, Vanessa. Cap rate, GRM, the 2 basics, guys. Know those 2 calculations. Teach it to your sellers, teach it to your buyers.
Let me see here. Yeah, thanks guys. If you guys don't have any questions, we're gonna jump off today. We didn't have a super hard close time, so I'm just making sure we've got them all for the most part. I think we are good. A lot of tax questions. I'm excited for that tax class, actually, because that means I don't have to read the books that you read.
Yeah,
that's the way I cheat. I'm like, just Patrick, be my friend and tell me all the things I need to know.
We are friends.
I know. I'm so grateful.
I'm now friends with Miss Alaska, soon to be Miss America.
Oh, I don't know. I'll be praying. All right, guys. Well, you guys have a great week. Be blessed. Close some contracts. I'm writing an offer on a 4-plex right now. I need to just adjust my dates. So, go kill it. It'll be, change legs.
I'm headed to a property inspection with an investor on an investment property right now. So I'm about to head out the door.
Yay. All right, guys. Be blessed. We'll talk soon. Okay.
See you all later.